The flatbed outlook for 2019 looks significantly worse compared to 2018. Brokers, carriers, and Wall Street agree freight volumes are stagnant. The economic outlook depends on the data points you believe. And we recap the radio show, independent contractors, rails, futures, and data. Then it's on to the other big headlines of the week. Private equity is on a mission to bring transport and logistics into the future, and autonomous electric and regulatory barriers. Navistar's Gilligan paints a path forward. I'm JP.
And I'm Chad.
And we discuss all these issues and more on this week's episode of What the Truck.
And we're joined by the Sultan of Sonar, Zach Strickland. Welcome again.
Hey, guys.
Great to have you on. Way to begin with a whimper. No, seriously.
But we'll end with a bang.
Boom.
Oh, I like that idea. Redwood Logistics is one of the nation's fastest growing logistics providers, fueled by industry-leading technology and a passionate team of experts. From multimodal brokerage and dedicated truckload to third-party logistics and TMS consulting, implementation, and integration, Redwood Logistics delivers next-generation solutions for its clients and much more than a truckload. One of the things that we're celebrating, because so many things are happening this week for us, is this is a focus today on freight and tech and innovation. Because what's going on today, guys?
Freight futures contracts are launching in Chattanooga on the Nodal Exchange, and trading has begun. And it's awesome. We've been working for years on creating this financial instrument to de-risk carriers and shippers from spot market volatility. So it's super exciting.
And tomorrow on Saturday.
Yeah, the case competition.
That's happening. You want to give us like a little down low on that?
Yeah,
Zach?
So we've got about 11 universities.
14?
Yeah, 14. Oh, yeah, 14.
now.
Yeah, okay. Well, with 60 students participating, they get a cash reward of $9,000 if they win, and they get the case outline is basically just a standard, like, real-world problem that we came up with a few other people, and they're tasked to solve it as creatively as possible using actual data.
Give yourself credit. You originated this case study.
I did provide the ground level base work for it. So
Cool,
so it's
that'll
like,
be so cool. So there's a bunch of kids at our new headquarters, kind of camping out for 36 hours, basically,
at least, yeah.
Just crushing sonar data, going into this thing, doing these deep dives, and hanging out and competing against each other. It's really cool. I feel like it's part of our general vibe of bringing in the community, bringing in new people, talent, showing them how interesting problems in freight are, and kind of we're working on the pipeline for young tech data savvy workers in this industry.
Well, they're going to be drinking beer from the taps at Freight Alley as well, right? As I understand,
I don't know.
during the competition.
Yeah, they might. Yeah.
I mean,
Just kidding.
Okay.
if they're
if they're 20,
age,
if they're
right?
21, maybe.
But anyway, by the way, what are you guys drinking?
We are drinking.
I didn't mean to catch you off guard.
Yeah, so Zach brought over a growler from Naked River. You want to tell us what's in the growler?
Yeah, it's a Citra Nova. It is one of their hazy IPAs. 5.6% alcohol. Very lovely. Quite juicy.
Quite drinkable.
Yeah.
Hazy.
Quashable. You also brought in a Trim Tab Brewing Mosaic Singularity. Mosaic kind of starts...
Mosaic Singularity. That's such a weird... what does that even
starts to
mean?
taste the same, but I guess that's because it's just a single variety of hops.
But...
oh, no.
Yeah, you really mispoured that.
Got aggressive.
That's a very thick head. Getting a little bit spilled. Okay, let's move on. So the flatbed outlook for 2019 looks significantly worse compared to 2018. This was an article written by Dean Croak, our Chief Insights Officer, a wonderful man whom George Abernathy once called the most interesting man in freight.
Yeah, he's legendary, isn't he? I think he was driving his family tractor at the age of 4.
12.
No, 4.
Oh, tractor. Oh, I was thinking of thinking of a truck.
Truck at 10. At 10. Apparently, because his dad had sleep apnea.
Well, they do things differently in Australia.
Yeah, down under. This is awesome.
Everything's upside down, first of all.
One of the things I think that's cool about so John Kingston, when he talks oil, my gosh, he can connect it to anything. It's like 7 degrees of Kevin Bacon, but it's like with oil, literally how can he find a subject that relates to anything? Well, let's see. I think others can do it too, but with their own respective categories. Well, with Dean, it's flatbeds.
No, it's trucking in general.
Well, that's true, but I mean,
this is the man who
this guy can take flatbeds and connect it to every single thing that's happening in the world.
This is the guy who literally if you're on the way to Atlanta with him driving in a car, if you pass a semi, he'll snap a picture of it and then go through all of the FMCSA violations on it.
Yeah,
he's a Rain Man of trucking.
Yeah, he knows exactly what's going to happen down the road. He said he could actually predict people that were getting pulled over. He's really into the data of everything too, so he's worked on a lot of
everything
models.
From the physiology of drivers and how that relates to sleep cycles to the way that trucks are spec'd out, to markets, to everything. And he wrote this great chart of the week. Strickland abandoned us to spend a week in Napa Valley. So Dean Krogh had to pick up for him. But this is a really great article. It goes into industrial data. It goes into manufacturing indices. It goes in, what else? New orders indexes that are, new orders are slowing down.
Well, he kind of ties a lot of these economic factors into what creates the flatbed freight, and I think that's really important. I don't think a lot of people, even shippers, don't look at the big picture, the big picture of macroeconomic influences and factors on their business.
Right.
And flatbed is very influenced by a specific type of freight because obviously,
it's industrial products, it's construction, and it's business investment, especially with regard to heavy machinery.
Yeah, it's essentially things that can't be palletized or packaged real neatly, long pieces of wood and long pipes.
Steel.
Yeah.
A transformer or some large piece of whatever.
A lot of raw materials.
And it only represents 12% of the entire trucking over-the-road industry. But
what's interesting about it is that it represents it gives us insight into a different part of the economic cycle. So if you look at retail, which is 16%,
yes,
that's sort of the end. That's what people are buying. That's the consumer. That's consumer sentiment. That's how much money people feel like they have in their pockets. That's how the S&P 500 is doing. But flatbed is way before that. Mm-hmm. Flatbed is how businesses perceive the demand for their products. Should we build another factory? Is there going to be demand to build the subdivision and move these excavators into this land and grade it and build a housing complex? It's a leading indicator compared to a consumer packaged goods.
But it's also extremely volatile and seasonal. Yeah. Flatbed kind of dies off in the winter, obviously, because the weather doesn't permit you to carry things outdoors. But also the material, construction season doesn't really start in earnest until the weather warms up. So a lot of factors kind of it has a huge swing up and down. And his chart actually shows that last year was one of the the largest swings up that we've seen in recent years.
And because of that, he actually suggests that if you're, to do a year-over-year comparison can lead to misleading because of not only 2018 of course began super hot, and it was tight on capacity, but it was just such a perfect storm of things, right? It was the tax thing, it was the ELD thing, it was the leftovers of the hurricane.
For sure, lowering the corporate taxes and allowing companies to get all of that depreciation and write it all off in the first year definitely spurred a lot of business development, business investment.
I love the tie together of the hurricanes because I think people kind of discount once that news kind of hits, it's kind of off everybody's mind for a while.
After a week or two.
I know, I was in the freight market at that point in time, and the hurricane hit early September, Hurricane Harvey. Leveled Houston in early September, and then it really didn't have a huge impact until October because by that time, everybody had gotten in, started cleaning everything out, And then all of a sudden we had all this just mass disruption in October, and then that lasted throughout the rest of the quarter, even well after Harvey was no longer news.
Yeah, I mean, it's one thing to have to talk about these like specialized logistics providers that do disaster relief and bring in bottled water and things like that. But it's a whole nother thing when you think about like, okay, if 20,000 houses were flooded, who's going to bring in the carpet to fix that? Who's going to bring in like lumber? Who's going to haul the stuff out of the city? Especially Houston, I think was kind of a black swan. I mean, it's America's fourth largest city by population. The fact that the majority of it was flooded, I mean, was truly catastrophic in a way that most hurricanes hitting a random part of interior Florida aren't necessarily going to be.
No, and most people haven't seen that kind of devastation before. That's tremendous amounts of damage, just billions of dollars. That's like, think about $1 billion. That's not really something you can really put your head around.
No, and it's especially when you think of like billions of dollars of damage to like homes, because it's like that's like a couple $100,000 a pop times thousands and thousands and thousands, and stuff has to be moved out of the market and stuff has to be moved into the market.
It takes a long time.
It takes a long time.
No doubt, and things that happened this year that we're looking at. I mean, there was California wildfires and there was this polar vortex that probably inhibited flatbed growth. So that the overall outlook for 2019 is that we may be able to see some modest growth because of some factors that held us back. Another misleading thing from year over year, though, is that oil is more than 10% below last year's prices.
Yeah.
While still growing.
Production's still up.
Yeah.
Production's still up. That's what I actually kind of want to quibble with the dean on that point. He kind of said that it might sort of lessen the incentive to produce. That's not actually what I've been hearing from people like Rystad Energy, people like oilprice.com, people that really study the Permian Basin and the economic, sort of forces there. What's interesting about the Permian Basin right now is that production is projected to increase by a lot this year, and it's being driven not by the small players who have been in the market for a long time. People like Pioneer, Apache, Occidental, Concho. Those are all the little guys who lived through the 2015-16 downturn. Right now, ExxonMobil and Chevron are coming in. They've seen the sort of model be proven out. They are looking to consolidate a lot of these small companies. Even though they're making money, their CapEx is outrunning their free cash flow still.
That's crazy.
And so, yeah, I mean, it's a difficult business to figure out. But now the megas are coming in, thinking that they can roll these companies up, lease out a bunch of land and really, realize some economies of scale. So I think that production will go up, and I think even if WTI pulls back a little bit, it's not really going to matter to someone like Exxon or Chevron.
They have a low cost threshold, so they can actually operate. That's kind of not unlike what a private equity company does.
But overall, to what extent are you quibbling? Because it sounded like you're still suggesting that there's going to be modest growth ahead, and I think
so. WTI broke through $60 a couple of days ago. President Trump tweeted. The Trump oil call came through again.
Really?
And pulled it back a little bit. I guess what I'm saying is that if oil is oscillating between 50 and 60, which is less than it was last year, that doesn't matter. Like oil production in West Texas, which is very trucking intensive, is going to increase by a lot in 2019. The price is what's happening now is the entry of lots of new capital, the multinationals like ExxonMobil and Chevron, a lot of consolidation, and the price going up and down is not going to stop them from drilling new wells or completing drilled wells.
Yeah, awesome. Well, okay. Well, we will see. I mean, that's a big view that you're taking, and I dig it. You guys are getting it right here on What the Truck. On our 61st episode, we've been at it a little over a year. Thanks for checking us out if you never have before. JP, similarly, I believe you broke this story of brokers, carriers, and Wall Street all agreeing that freight volumes are stagnant. Well, they're stagnant. I mean, they're
year over year, they're stagnant.
year over year.
But it all started really with, well, I have to say it started with our data, but we knew this, almost 2 months ago. But finally,
yeah, we've been tracking it day by day.
Last week, Covenant issued a first quarter earnings update, trying to kind of get a soft landing on their call, lowering guidance for the first quarter, saying that their earnings are going to be anywhere from 33% to 50% lower than the street consensus expectation. And they, CEO David Parker kind of shied away from any kind of macroeconomic, sort of
Right.
sort of reason for this. He kind of blamed it on these
weather.
Well, we
weather.
talked about it last
So it started with
week's
that.
episode.
It started with that. We saw some research this week from Susquehanna Financial Group suggesting that West Coast container volumes are down 9.6% year over year. And overall rail volumes are down 4 point. So over the sort of the 4 week moving average for rail volumes, it's down 4.7% year over year
In February.
in February. And now no. This is the past 4
current?
weeks. Yes,
Okay.
the past 4 weeks. Yeah,
I mean, rail is its own animal.
Yeah, but-
really been disrupted by weather.
But no, it's also. I mean, that's a real thing. I've looked at the data too. I mean, it's definitely down year over year. I mean, rail does definitely correlates with trucking and all
then
that.
Sure.
And then I talked to some brokerages yesterday as well. And they were, I talked to Trident based in Chattanooga, but I was actually talking to their branch manager in Tampa, their new office.
Right.
Rush Feldhacker, great guy. He's an old Access America guy, actually. Talked to people at Nolan Transportation Group, NTG out of Atlanta. And
Molo, right?
yeah, and talked to Matthew Vogrich, president of Molo Solutions in Chicago, and Vogrich, he had a little bit of a different take. They're still in like hardcore growth mode, and they are actually seeing their own volumes rise week over week, just because they've got all these RFPs going live. They really busted their asses servicing their customers' freight last year.
Right.
They're kind of getting rewarded for that now. I mean, they're literally like they're 18 months old, right, or 20 months.
So
old.
they're in super growth mode. So their curve's not necessarily representative of the rest of the country.
Right, but you look at a brokerage like Trident that's 4 or 5 years old. They have a lot of exposure to the spot market. You look at Nolan Transportation Group, which is a large, quite a large 3PL that really has a beat on the market, and they're all saying that. Yeah, I mean, the volume is not, basically every market in the country is soft.
Yeah, and one of the interesting things in your article, you state at the end there is basically how shippers are basically playing the spot market for a totally different reason than you would normally think, and that's because their contract rates are so elevated. They're trying to bust out.
What's awkward is that some of these brokers are seeing their own customers post contracted freight, lanes that they have contracted to load boards for prices lower than what they contracted. So now the broker has to go back to the carrier and be like, okay, like, what we need to talk, like, let's move our rate down. Like, come on, like,
yeah,
that's
you
a weird
guys,
situation.
let's work this out.
Yeah, but they still haven't come all the way back down. I mean, that's a hard thing to do, to pull back down a contract.
They haven't come all the way back down. The last piece of this, Wall Street, Ravi Shankar issued a note Wednesday morning,
Right.
basically saying that, because what Morgan Stanley does is they survey carrier sentiment, and they talk to carriers, and they figure out like how, one of the basic questions they ask is, how much do you think contract rates will go up in 2019? And essentially that number has gone down over the course of this year. It has slipped from, anywhere from like 5 to 7% down to what it's negative now. It's like less than 1%.
I don't remember that one.
Yeah. So he wrote, in our latest survey, respondents expect 2019 rates, excluding fuel, to increase 0.83% year over year on average, versus 1.12% in their last survey. So basically what I'm saying is that carrier sentiment is deteriorating.
Yeah, that's exactly what surveys tell you is sentiment.
They've revised down from sort of mid to high single digits down to like less than 1%. And it's going to keep going down. Like I think Chainalytics is now calling for 5%, 5% negative year-over-year comps for contract rates. I was looking at DAT rate view the other day, and I was comparing like just the national average in broker to carrier spot and shipper to carrier contract rates, and that spread has continued to blow out.
Oh yeah, no,
it's up to 41 cents a mile now.
But those are.
I remember at the end of the year it was like 23 cents a mile. Now it's 41 cents a mile. So that's going to continue.
It's going to pull them down,
pull a contract down, and that's.
But contract is a very slow moving entity, so.
It is.
We've been advising that we haven't seen the bottom.
Yeah, but it does appear. I mean, looking at some of those
bottom,
rates,
the bottom for spot is probably in. The bottom for contract is not.
Right. That's exactly right. Because I was about to say a lot of the spot market data looks like it's hitting floors because it's like flattening out. If you're looking at it and it kind of slowly comes down and then it just kind of levels.
Yeah,
that appears to be happening right now.
And that's what's happening with available capacity.
So we're hitting rock bottom. This is great.
It's not necessarily rock bottom. Things can always get worse, but they can always get better too. But
what would be worse is if there was like a significant economic downturn, and
Yeah.
GDP went negative, and freight volumes truly disappeared.
Yeah, because volumes are still pretty good. I mean, if we hadn't been coming off like the hottest year on record, like 2017-18 was like one of the sickest years on record. In terms of freight movement, and everybody has this kind of recency effect about how they've, you come outside.
The world's falling. The sky's falling.
Yeah, Donald Broughton actually had a really good analogy about this. He said, it's kind of like going outside in the spring and it's 60 degrees, and you put on shorts. If you live in like Connecticut or something, it's like, oh man, it's burning up outside. But 60 degrees in September is like frigid.
Yeah, you're right.
Yeah, I mean, overall, that's just my overall like takeaway right now is that as we're looking at all of this and we're taking it all in right now is like we're still growing.
Yeah, it's still a decent segment, but the problem with that in trucking, when you've increased your infrastructure and built your capacity up to kind of handle, you think you're going to get more because you budget. Everybody does this in the sector. They budget. Nobody budgets like contraction. They all budget growth, and so when you go out there,
isn't it funny the way it works?
It's I've always been quite critical of that process, but without getting into the details of it, everybody throws like some percentage on top of their budget every year because it's simply such a daunting task to go through every line item and say, well, we're going to do 2% here, and that's going to increase here, but that's also going to contract here. So they just say we're going to set this goal of 5%. Done.
Yeah, sure. I see that. I remember, though, all too clearly the urgency that we all felt last year with I don't know that it didn't feel like the sky was falling, but with capacity so tight, like we were talking about it week after week after week. Oh, capacity's so tight. What are we going to do? Like you can just imagine the truck orders going in and people want and actually as a result, I think that truck orders are going to be relatively strong throughout the rest of 2019 because they were so backlogged.
Actually, they're way down year over year, of course.
Well, orders,
but
deliveries.
Still going to be coming in.
They're coming in
the rest of the year, and then in 2020 it's supposed to be softer.
Yeah, I want to say they peaked out in late fall.
But I guess my point is, like, we are like. We do respond to that. It's hard not to think, oh, this is the new normal. Like we were even saying, well, maybe capacity is going to kind of like stay kind of elevated in some of these ways. I just remember that. I remember us talking, oh, the pendulum swings, but no, this is kind of the new normal. As you just said, we're prisoners of the moment.
Yeah,
recency
everybody
effect.
is.
So this is how these things happen. I wonder how many people were or how many carriers, how many owner-operators last year were like, hey, things are tight, I'm loving it, and I am not going to increase my capacity at all. Mm-hmm. No, because it's just going to swing.
Everyone is like, hey, I'll just add one more truck.
But I mean, let's be honest. That's what they're supposed to do. Like they have outside pressure saying, you're either growing or you're dying. I know,
Yeah.
to use a Tommy Boy quote. You know? And that's simply not necessarily, I mean, growth can come in different ways, not necessarily in just straight, material.
Right.
Or
number of
load
assets.
volumes or assets or whatever that is. I mean,
Wisdom.
to gain market share
There it is. That's wisdom.
Yeah.
Growth can come in different ways.
Yields,
That's so
yields
true.
for example.
yields. Exactly. Hey, there we go.
Have you considered that?
Yeah. Margins and
Well, I feel like
Those
in
are
a
great.
way we've already segued into Brian Straight's really, kind of deep dive here. His economic outlook, depending on the data points that you believe, and and one of his takeaways, he was at the ACT's Research 60th seminar in Columbus, Ohio, and their chief economist Sam Cahan of ACT Research was kind of saying, hey, the forecast, the GDP forecast for 2019 is 2.1%. Yeah, down from 2.9 in 2018. And it's a little scary to think that the projections are 1.9% for 2020 and 1.4.
They just revised the 2018 number down.
Yeah, down.
It's like 2.6.
and see, that's exactly what
to
happens.
2018.
yeah.
Yeah.
They retro revised it.
Yeah, they always do that.
They get-
Okay, well, whatever the case, I'm thinking.
No, I'm saying they did that like today.
Yeah,
Gotcha.
but they clean the numbers up, so they get more information in, and then they're able to
I wish
kind
they
of-
could clean the future numbers up. But anyway, it looks like there's a slow descent down. Yes, but it depends on who you ask and the data and what you look at. But and how is the glass half full or empty? I'm still seeing
There's
growth.
There's a lot of confusion out there right now because you do get so many discrepant data points. Like the retail, I think he cites in there as being like everything's great.
Well, it was bad in the holiday, but now it's picking back up, which is
good.
weird for the first quarter.
Right.
You know,
Like
first
that-
quarter GDP has been like really kind of weak for a number. Going back like pretty much every year. Like it's actually plunged below like 2% like several times.
Yeah, no, we are seasonal creatures. When the winter happens, we actually slow down.
And especially if it's
Yeah.
a severe
Back to
winter.
your recency bias.
Yeah. No, that's right. I mean, we definitely have a seasonal. Like if you look at kind of activity for the human during the week, there is a rhythm that everybody operates on, and
yes.
and transportation is the epitome of this. You can look
Yeah.
at people like kind of scheduling
Yeah,
orders.
shippers avoid Wednesday morning.
Yeah, no, like Monday.
I know, right?
Like they come out hot on Monday because it's like, oh crap, there's all this stuff that's there, and then they kind of slow down, and then towards the end of the week, Thursday, Friday, I'm about to leave, I don't want to work anymore, and
Yeah, we can literally we chart that on Sonar.
Yeah.
We see the weekly cyclical cycle.
no, it's this industrial rhythm that we've all kind of got programmed in us, and it's no different throughout the course of the year. Like we ramp up in the spring because it gets warmer, everybody starts going outside, we do more things, and I hate that kind of anecdotal like evidence, but there are quantifiable things that you can do with that in terms of economic sales and output and things like that. But
you can't plant crops if the ground's frozen.
Yeah.
You can't excavate to build a building if the ground's frozen.
Yeah, I
Right.
mean there are reasons for seasonality.
there's certain reasons, but
People
Rhythm.
people drink more Gatorade when it's
Hot.
when it breaks above 85 degrees in
Yeah.
Texas than they do when it's 50.
More people sleep at night.
No, and we do sleep more in the
There
winter.
are
I mean, that's
rhythms.
because there's less
Yeah.
light available. But you don't really think about these things in terms of economics.
We add body fat, or at least I do.
Well said.
Okay. But I see overall, Zach, what you were saying about there's confusion, and I suppose in some ways that illustrates what Brian Strait was covering at this conference with this particular article. Like, you can look at certain aspects of things, and you can, almost spin them a certain way, or you could hyper focus on, consumer spending, or
Right.
wages or unemployment, and get a very positive spin on things, or you could look at carriers, volumes or tender rejections and get kind of a different thing, or look at retail sales and how there was no Christmas in a sense.
And I think one of the things that Cahan, I believe it was Cahan, said that I thought was pretty interesting actually, and pretty insightful, is that of course the data is mixed. Very few people there's very few recessions that have been, called by a consensus of economists before they actually happened.
Except for the yield curve inversion.
Oh, he actually straight mentioned the yield curve.
Yeah.
But actually, if you go back to the original dissertations on the yield curve and recession correlation, the 6 month and 10 year the 3 month and 10 year have to be inverted for a whole quarter. Before.
Not just like
I haven't gone
minute.
back to the original the dissertations.
You're welcome.
The yield curve. Well, thank you.
But no, what I was going to say is that he said what's more likely is that we have rolling recessions in certain sectors, whether it's retail, housing, manufacturing, whatever. Sort of these like mid-cycle pauses that we saw in 2011, 2016, things that can hurt freight, but don't necessarily mean that the world's ending.
Yeah, no, 2016 was a weird year because we weren't in technical recession or anything like that, but we certainly felt it out in the world. Things slowed down for us for sure. Yep. We had no idea why or what was happening because we simply just didn't look, but we thought, oh, man, we're doing something wrong. And it turns out, no, everybody was just slowing down. Yeah. And as a trucking company, you never know what your shippers are really experiencing because they're always going to tell you, hey, we're having a great year. Because most of them are publicly traded companies that are, they have
supposed to be saying
they always say that.
Yeah, they always say that.
Until they can't anymore.
And because there wasn't as much, transparency and information.
Did I say great year? I meant, we're doing some stock buybacks.
No, actually, we're not giving it to you because your service stinks and your rates are too high. So if we could...
Right. Or it could be because our customers don't have any money.
Right. Or we're not selling anything.
But you guys aren't pessimists or anything.
I'm just stating
Call
what
it
happened.
like it is.
Saying what happened.
Yeah,
so tell me about this radio show on last Saturday, man.
Last week on Road Dog, the Road Dog Channel 146 on Sirius XM, we talked to a number of people. We talked to Greg Feary, the partner and transportation attorney at Scopelitis, about that controversial, the Supreme Court deciding not to look at the case. What does that mean? It was kind of interesting what it means for independent contractors and owner operators. We talked to Todd Trenowski of Rail, and he was talking about the disruptions in service due to weather, we also talked to Kevin Hill of Carrier Lists, talking about data, talking about how they collect it and how that gives us insight into the industry. But of course, very importantly, because of the context here, we talked to Addison Armstrong, our executive director of Freight Futures at FreightWaves, and he talked to us and, he educated us a little bit on the Freight
Tell me about
Futures.
that conversation.
Well, I mean... It's interesting. Like, he was just kind of giving us overview of what's going on, about how, over a 2-year period, how FreightWaves and the Nodal Exchange and our
DAT.
Thank you, and DAT did a lot of number crunching and studying on the liquid lanes in the country and how we came up with the lanes that we did, and how when you put them all together in aggregate, you can get a national kind of number. And so, like, he did a great job of, like, giving us an overview, and yet, not talking down to us about kind of what can be a very complex subject.
Right.
Kind of educating us.
And there's going to be like a lot for us to learn, honestly, like going forward, as the trucking freight futures contract launches today, starts being traded. Like, we're going to be talking about things like forward curves and kind of what the market expects for prices going, into the future, up to 16 months into the future.
Yeah, no, I mean,
I think that, like, there's some sort of complex, financy type terms that we're going to try to break down for you and explain to you, because we think that a lot of these, the data that will be available, because, it's essentially, it's all of these market participants and trading participants coming together to think about, like, what prices will do in the future. And, like, if it's better than a survey, because people are putting their money where their mouth is. And so, like, I think, it's going to be really interesting to kind of see the insight and the transparency that even just, people who aren't necessarily participating in the market, people who aren't trading futures contracts, what they can learn from it, and sort of, the way that they can pivot strategically based on what the market thinks is going to happen.
No, I totally geek out on this stuff. I mean, I was a finance major back in college, thinking that I was going to come out into the world and rip apart the stock market with my investment savvy. And this is pretty cool to me because I kind of reluctantly came into transportation, and then to see this financial instrument, which I studied in college quite thoroughly, kind of start to pervade the transportation sector is really cool to watch, because I think a lot of people in transportation don't understand exactly how this could really mix with what they do. And to me, they simply don't understand, like, hey, this is going to provide you, actually, whether you participate or not, with a lot of information. And it's real. Like you said, JP, like it's like a farmer. It's like a farmer,
in Iowa who grows corn. Like, they might not be trading on the floor of the Chicago Board of Trade, but
which is kind of the origins of the futures market.
Exactly, but they can look at prices and say, hey, wait, I'm gonna store my corn in a silo and wait until December to bring it to market when the prices are supposed to be better instead of right now. Like any little person, the little guy with exposure to these prices can use them to make their business better.
Yeah.
Well said, guys, especially considering you're not licensed to talk about the freight futures.
Actually, I'm allowed to.
You're licensed?
Oh, wow.
Yeah.
Oh, wow. Well, you did a very good job, I must say. That was safe sailing. But I want to just the FreightWaves radio show will keep coming live to you each and every week from 3 to 5. And this coming episode tomorrow will focus on all things tech. We're celebrating the launch of the trucking freight futures, as we just said, and the Collab Tech Innovation Collaboration. So that'll be exciting.
It's all happening.
That's what I like to say.
I know. I stole it. It's mine now.
All right. Well, hey, and we've got an approved person to talk about freight futures here on the show, ladies and gentlemen. Wow. So, hey, well, speaking of difficult things, challenging things to communicate to our audience, you want to talk to us about private equity?
Said enthusiastically by Chad.
Yeah.
Private equity. Well, no, but the reason we're even talking about it, let me just say, is that we're talking about freight and tech and innovation. And hey, private equity and VC, venture capital, in transportation logistics.
This is how it happens.
Yeah.
Can be an exciting topic to talk about.
Yeah.
It can be.
Yeah, so I wrote this story, and it really started from this McKinsey and Company annual report on global private markets. It's their 2019 report. It's focused on what happened in 2018. It includes things like real estate and infrastructure, natural resources. But the part that I was interested in was private equity in the United States, and how that would relate to transportation and logistics industries. And private equity. It sounds like a technical word. It's not actually that complicated. Strickland, can you kind of explain what the concept of private equity is?
So private equity essentially is, a company or a person or a group of people that invests in multiple entities or companies or organizations, and they try to find ways to make they combine other companies with each other to try to figure out a way to make them, either grow or increase in value.
Yeah, and so it's the sort of the converse of private equity would be like the public stock market, where people buy pieces of a company and hope that company goes up in value. If you buy a lot of that company, maybe you can influence what the management does. But private equity is like, it's almost like one shareholder buying the entire company or the majority of a company, and then injecting a lot of money and trying to basically take a good business and make it better.
Yeah. So ideally what a private equity company does is they find a company that, may not be complete. They may be doing well enough, but if they combine them with another company or another entity, or maybe they just need extra cash. And
maybe they need to build a facility in a certain market that their assets are perfectly suited to operate profitably in.
Yeah, or maybe they just don't have the visibility to really kind of grow appropriately, and they can't enter a space. Maybe they're stuck.
So it sounds like you're distinguishing already a little bit between what private equity is and venture capital.
Yeah.
I mean, venture capital is private equity, but private equity is definitely not just venture capital.
Exactly. So venture capital is about really making a lot of, typically smaller bets on founders, especially early stage venture capital. These are companies. Okay. These are companies that are still in growth mode. They're cash flow negative. They're not mature. You're financing organic growth. Private equity, and I should also say this: the tolerance for failure in venture capital is much greater. If one out of 10 companies succeeds and does well, that's fine. In private equity, what you're doing is you're buying mature companies that are already profitable, unless you specialize in distress assets, which is totally different. Mm-hmm. But essentially, you're buying mature companies that are already profitable. You're trying to make them better. You're trying to increase their value so you can sell them in, call it 4 to 6 years.
That's right.
But the tolerance for failure is much lower.
Yeah,
the investments are larger, and you need every single company to generate a positive return for your limited partners.
Yeah, and kind of the mutual, like the commonality here between VC and private equity is that, if they do both need money, that is kind of what private equity can offer as well as VC. But private equity, like you said, has more of an operational concern, where VC kind of steps back and says, we like your concept and your idea. We're going to help kickstart you or get you off the ground or at least push you off the runway a little bit further.
Right.
You've had some experience with private
equity. I have. I can tell you exactly how.
Tell us the story, Zach.
So
what happened?
My old company was bought by private equity back in 2015, and our experience was not great. It was pretty bad, actually. And one of the, I met several people along the way. This is actually where I got a lot of education from multiple, outside sources. We met with consultants. I met all sorts of M&A experts, all sorts of people across the spectrum. Our board members,
wow.
One of our board members, hysterical. He'd been around a while, and he told this story about how he sold his company to private equity back in 2008. And there were a bunch of bankers that kind of used all these financial instruments and, thought they knew everything they could know because they could measure revenue and profit and all this kind of stuff. And he kind of laughed, and they bought it for a multiple higher than he thought it was worth. And he was like, yeah, I'll sell it to you. Well, he brings
less than 2008.
Yeah. 2008.
Oh, great timing. Timing's everything.
But still, less than 2 years later, he buys it back at a fraction of the cost. But he also cites that they really did not understand the business at all. So what they did was they came in and didn't really have a good action or a game plan for it.
Okay.
Anyway, he kind of relayed this story in his interview with the guys that bought us. And they were kind of sitting there going, yeah, that's true. That's real. None of the guys at our firm
They weren't actually listening, though.
Yeah, no. They were like, oh, man, this guy's great. And he's on the board for sure.
After we buy it.
Yeah.
Which we're not going to do.
Yeah. The problem is that they didn't really pay attention to the lesson of his story, which was they came in with all these financial figures. They didn't understand the operation of what he was trying to do, the company, or anything. Within a year or two, his company was already back up, making profit, killing it. But these guys kind of did the same thing. They came in and said, we're going to just clean up because you don't know what you're doing.
A little hubristic.
Yeah, they didn't really have a game plan. They just said, you're obviously operating inefficiently, and we're going to help you clean up. Well, this was before 2016 when the economy kind of took a dive. But again, the thing that private equity should have done here is they should have had a real game plan for how to grow us without just coming in and saying, we're going to cut a bunch of costs, even though we have no idea why you're inefficient.
Industry specific.
Yeah, because they're financial people. They should not know how to run it. They should not know.
You just can't just you can't just put like lighter fluid on it and the fire burns. I mean, it'll burn. But your burn rate will get.
They legitimately told me there's $1 million of EBITDA on the table here because of your inefficiency, and I was like, well, why?
Yeah,
and I was
like, maybe I have a few answers for you guys.
And I was like, because I was really the data guy for the company. Like I ran the numbers, so I was like, well,
you're saying that I'm not doing my job.
Whereas I believe that you're accurate in terms of there's inefficiency here because there's inefficiency in every company. That low-hanging fruit buzzword that you hear in every board meeting.
Inefficiencies, solutions.
But he could not provide me any specific examples. And so they just press constantly, like, you're just not doing a good enough job. Do your cost better. Eventually, it just tanked the company. I mean,
that's the long and short. You're just cutting right to the
and they tried to grow revenue that was unprofitable, and lots of things like that. I mean, that's one example about how private equity can go bad. The sort of mismatch between the financial expertise of the investors and their operational know-how, especially in transportation, which is exceedingly complex, and most of the operators have this deep, even multi-generational tribal knowledge.
No, and this is the problem with a lot of trucking companies too, is because you have a financial segment of a company and you have an operational segment of a company, and they do not communicate very effectively.
Which you have seen. You've been in that corporate world.
I've literally lived in the middle of these two sectors. And even when I was there, I had trouble translating to each side what each one was trying to do. And that's effectively what happened at our old company, is that because they had so much success with the financial side, they thought they could apply it to the operational aspect, even though they had no idea what it meant to run a successful trucking operation.
Right.
Okay. So,
I think the larger themes, though, of the story are basically just that private equity is growing a lot.
Yes.
A lot of different kinds of investors are putting money into private equity firms to generate higher returns than, for example, in the public markets. We published a story last week saying that CalPERS, which is this, one of the largest institutional investors in the United States, the California State Employee Pension Fund, they approved a plan to put another $20 billion into private equity, which normally those pension plans are pretty risk adverse.
And overall, JP. So what? Let's overview of private equity. Why are companies not as likely now to maybe go IPO in public? They're staying private.
Question.
They're staying private a little bit more. What is it about valuation?
There are three reasons, and one of them is the most important. The main important reason is that for the past 6 years, there has been no premium in valuations from going public versus private, which means that if you are trying to sell your company or part of your company, you can either decide to go on the New York Stock Exchange and sell it to a bunch of different people, or you can go and try to sell it to a private equity group. Historically, you could get a lot more bang for your buck on a public market. For the past 6 years, there's been no meaningful difference.
Right.
So no meaningful difference. So then why are more people choosing private? Because it has other advantages. At the Stifel conference in Miami Beach, Stifel Nicholas, the investment bank, held a transportation logistics conference in Miami Beach this past February that I attended. John Larkin, an investment banker from Stifel, moderated this panel on private equity and venture capital. And one of the things that he said was management tends to like private investors, private owners better because they prefer having a small group of committed people who have already bought into a certain vision, who, in theory at least, have some sort of operational know-how, as opposed to you go IPO, 700 different investors buy large amounts of stock. They're calling you they're calling you every day saying, how is business this morning? Can you give me an update? Why don't you try this? Why don't you try that? It's very diffuse. It's very fleeting. It's finicky. that people are moving in and out of your company. There's no real commitment, and you have to answer to these shareholders.
Yeah, no, it's rough.
That can be really problematic for management. Thirdly, compliance costs of reporting when you're a publicly traded company, you have to do all of your accounting in a certain way. You have to every little material change to your business.
Sarbanes-Oxley.
Yeah, right. Yeah, Zach's referring to the legislation that was passed in the wake of the Enron thing, which dramatically increased costs of compliance and actually has led to a demonstrable decline in the number of publicly traded companies in the United States.
It's very inefficient.
If I may, Zach, what was in the past, what were the advantages of being a publicly traded company over private equity? Why would, and I think this is our last question on this topic, so we can, so why now do you think that private equities are kind of emerging as almost like if not a preference, at least kind of equal to a publicly traded company?
Well, it allows the smaller companies to really be able to grow faster. I mean, before IPOs were a very risky venture, honestly. You got a bunch of cash real fast, and then you were expected to use it really fast and grow real fast. So it was kind of like getting your second raise of VC in today's terms. So you would basically be this huge. You would be expected to perform right away. Well, private equity actually, if it's done right, which I actually knew a guy.
It can be.
Yeah, it actually can be done right.
Nothing is, and we know a lot of great firms who do very well.
No. I talked to a guy who was certified for M&A and all that kind of stuff, and he gave me a full education on how it actually supposed to work, and they're supposed to have all these action items and game plans after evaluating the companies thoroughly, figuring out where they can work together well. And the private equity firm's job is to go in there and really, they don't necessarily need to know the business as well as the management,
right?
But they should be able to provide so much opportunity for each company to kind of work together and grow together. And they provide this space and also the capital, obviously, to kind of work well. You can't go out there and be a $250 million company and expect – I'm going to IPO tomorrow.
I guess I'm wondering, though, why the emergence, why this trend now? Are we seeing it? And I don't know how granular we keep going with this, but I'm just, there's obviously a trend happening.
So, and just to quantify the trend, from 2006 to 2017, the number of publicly traded companies dropped 16% to about 4,300 companies.
Yeah, the bottom line, Chad, is that it's
in the same period
cheaper.
In the same period, the number of private equity backed companies grew from about 4,000 companies to about 8,000 companies.
Right. No, I saw that.
And so that's
I know that's the trend.
Just for our listeners to quantify the trend, it's flip flopped. 10 years ago, there were more publicly traded companies than private equity-backed companies. Now, there's about twice as many.
No, it's significantly it's significantly cheaper to do that, and the return may not be as great initially, but the long-run return is certainly far more successful.
Interesting.
Right.
Well, it's a trend that we are covering,
and the money's available. First of all,
yes.
No, and it's a granted. You don't have to worry about your stock price after that first IPO day dropping 300% the next day.
Private equities, I think technically some could argue, if you wanted to do a dissertation on it, that goes back to the turn of the 20th century, but it's really been happening since the 1970s. That's as much as we're going to go into that, because we tried to explain that as if it was to a 5-year-old, but just trying to keep it clear and simple. But I don't think we did that. We're celebrating freight and tech and innovation. And one last topic that we're going to hit before our big deal, little deal guys. Brian Strait also covered a pretty cool, just what's happening with autonomous, as he is covering it from Columbus, Indiana. And, I feel like a lot of things are happening with Navistar. They're kind of giving us a sense of, hey, guys, the media headlines say that level 5 autonomous, when are we going to get there? When are we not? Is it ever going to happen? Do we want it? Do we? And it just goes on and on. But in the meantime, the builders of the OEMs original equipment manufacturers. If I can
The
even
builders of
remember
the
what it
OEMs.
stands. They're talking about, hey, here's what is happening in innovation this year. And it's connected vehicles, driver interfaces, fuel economy is a focus, of course, and emissions reductions, and also just they're calling them advanced driver assistance systems.
Yeah, I mean, and these are all attainable things. These are realistic goals. That level 5 autonomous stuff is years away, if not decades. These are things that you need to focus on first.
Decades,
dude. It's going to take a while. Is my point. Not necessarily that I know and can see the future, but it's to create a level 5 autonomous, you have to do everything that you just stated there first.
Right.
It's kind of like crawl before you run type deal.
Yeah. All right. Well, no wonder they're grabbing the headlines. All right. Well, those things are happening, and I'm just gonna, just cut to the chase. That is, there's, check out the article by Brian Strait, Autonomous Electric and Regulatory Barriers, on Navistar's Gilligan, painting a path forward. All right, JP, are you ready to take on and run the gauntlet of the big deal, little deal?
Let's do this.
Okay. Ready or not, then. Here we go. LiDAR company lands $60 million. Big deal or little deal?
I think it's a little deal. I think that it's a late entrant, and most of the leading autonomous companies aren't using LiDAR.
Chinese commercial vehicle market expected to continue softening through 2022. Big deal or little deal?
Big deal, not a surprise. It's very easy to scare Chinese consumers into tightening their spending.
UPS and Matternet launch commercial drone deliveries on NC hospital campus. Big deal or little deal?
It's a big deal. I think that these sort of local campus-based sort of, I think you've got the combination of like, small length of haul plus urgent supply. I think it makes sense.
Uber buys Middle East rival Careem for $3.1 billion. Big deal or little deal?
It's a big deal. They're consolidating ride-hailing in the Middle East ahead of the IPO. It definitely makes sense. Volkswagen partners with Amazon subsidiary to improve operational efficiency. Big deal or little deal?
Big deal. The partners complement each other well. It's a global industry platform that could be the beginning of an industrial ecosystem with transparency and efficiency, bringing benefits to everybody.
Indian logistics startup Delivery attains unicorn status with new financial raise. Big deal or little deal?
Big deal. The e-commerce industry has seen spectacular growth in India over the last decade, and it's now valued over $1.5 billion. How is that? That's a lot of cheese. That's a big deal.
All electric seaplane fleet coming to the Pacific Northwest. Big deal or little deal?
Big deal. That airline, serves more than 500,000 passengers, 30,000 commercial flights each year, and it's like they're turning seaplanes into e-planes. Is there anything little about that?
Canadian trucker XTL says hourly driver pay program is paying off. Big deal or little deal?
Big deal. The idea is to help length of haul at with companies like typical length of haul of 500 to 600 miles, and also to help the drivers fight the war on detention. So I think it's great. And
Layla is shaking
really
her head
long.
in disdain.
Really long. You're making me feel good.
2 minutes, 15 seconds. Wow.
Wow. Look at the extremely...
Layla's almost just mocking us. It's just just grinning like the Cheshire cat.
When I come on here, I do a
She's
terrible
happy
job
when
at
we
it.
fail.
After you guys nerded out on private equities for an hour and a half, I don't mind missing big deal or little deal by a couple of seconds. Maybe it's just me. No, this was a great episode. Good times. Happy to be here. Thanks to Redwood Logistics once again. And, let's just celebrate this weekend. Everybody come on down to Freight Alley where it's all happening. The case competition, freight futures, it really is all happening. Zach, thanks again for being here and,
Thanks, man. Good times.
getting in between us and figuring things out.
You guys started to fight there in the middle. I had to jump in between you. So.
It was a Zach sandwich.
And JP is already onto his LinkedIn. So that's it from here. All right. Peace out. As always, we go into more detail about each of the topics we've talked about today on our website, FreightWaves.com. We will continue to publish this podcast weekly, so be sure to subscribe to What the Truck on Apple Podcasts, Google Play, Stitcher, and SoundCloud. Also, make sure to leave us a review to let us know what you think of our new podcast. That'll do it for today. Thanks for tuning in, and we will see you next week on What the Truck.